Transferring wealth successfully starts with asking yourself questions that will give your family a better life now and for generations to come. In this podcast, financial professionals John and Michael from Copper Beech Financial Group guide you through eye-opening questions to help you discover the truth about your wealth. Now, on to the show.
Hello and welcome to The Truth About Wealth with John and Michael Priest of Copper Beech Financial Group. John and Michael have brought on another guest to today's podcast, and that is Peter Andersen from Andersen Capital Management. John, I know that you brought Peter on for a very specific reason. Why'd you bring him on the show?
Yes, Peter and I are mutual associates, and we've done some work together personally. He manages some of my portfolio, he's done a wonderful job. But Peter has a good focus on what's going on in the economy. And Peter, while I wanted you on the call today, we have our clients asking us pretty routinely, what's going on with the markets, with the pandemic, and what our expectations are with stocks and bonds and real estate and all the things that are happening around us. So I thought today would be a conversation on what you think the key issues are, and you don't have to get too political if you choose not to, but that's okay if you want to bring politics into it, because I think, from my perspective, that has a lot to do with a lot of concerns that some folks have with what's going on in Washington. So I thought we'd just have a nice conversation today and kind of give you the lead on it, and we'll pop in with some questions along the way just to guide you, maybe something more specific on some of the issues that we want to address. So with that,
sounds good.
I'm going to give it to you, Pete, and let's start with, where are we?
Well, we ask ourselves that question every day. I mean, as a money manager, I'm asking that continuously. And that doesn't mean I don't have a compass. But I would say this year is even more perplexing, if possible, than 2020. When we were in 2020, that question was just permanently unanswered. And I think we were all looking toward the vaccines, 2021, a turnover in administration as something that would give us resolve. But unfortunately, I would say 2021 is even more difficult to answer that question about where we are. And I'll give your listeners some guideposts, the way I look at things, especially from an investment perspective, and try to figure out a roadmap that could be more like a labyrinth, frankly, at this point, because there's so much data coming in, and we are in a tremendously protracted turning point, where we do have the vaccines, people are reemerging, businesses are reopening, but there is this nagging sense that maybe the virus will come back. We've had commodity issues, supply, demand issues. There's all kinds of things happening. And during a period like this, it's extremely important to stick to your plan and to not be allured into maybe a different kind of strategy that isn't comfortable for you, things like that. So we can spend some time going into more detail, but just as an overall summary, I would say we are on a much better track. It's noisy, but I am extremely optimistic that, number one, as human nature, we will not only survive this, but actually come out on the other end much better. And I do think we are headed that way, but we do have some fits and starts, don't we?
Yeah. I mean, being optimistic is good these days, because we're hearing a lot of pessimism out there. And I want to make sure that all the listeners get, again, your message is, you can't make crazy decisions right now. You got to stay pat with your allocations and trust your advisor that's kind of guiding you along the way here, and not get emotional about what's going on. Yeah.
That's right. And this is the most important time in an investment cycle to be having, I would say, almost continuous conversations with your financial advisor, because it is such a fluid situation. And, what has exacerbated all this too, let's just put this in perspective. The press is in the business of selling ad time. And we know for a fact, it's been said on CNBC many times over the past years. They say it kind of tongue in cheek, but they say, we love volatility because we get more eyeballs on our screen. And when you get more eyeballs on the screen, that means you can raise your ad pricing. So I often amuse myself thinking about one day we turn on CNBC and Joe Kernan or one of them says, you know what, there's no financial news today. And why don't you tune in tomorrow? But as we know, that's never going to happen.
We would.
And they are, it's easy pickings this year because there is so much news. But I want to caution listeners into taking that with a little bit of cynicism, that where is this news coming from? What's the purpose of telling us this news? Does it help me make investments, or does it just make me more agitated and uncertain about the future? And unfortunately, that is part of the public press and the American way. Is there's a lot of anxiety out there, and some of these news programs do feed on that.
Yeah, and the other part of this, and again, to talk about what's going on in Washington, that's a lot of angst for a lot of people. What's your read on what's actually going on in Washington? Are these tax proposals going to come to pass, or it's just going to be talk?
I think.
What's your call on that?
Well, number one, I think we would all agree that the country is probably the most fractured it has been and most polarized in some time, at least since I was a teenager. Vietnam War, that kind of thing. So we are embedded in a period where there is so much disagreement. And we started this year with, a colossal amounts of disagreement and not necessarily civil, respectful disagreement on either side. So you're entering into a political environment that is so supercharged. And in terms of taxes, yes, I do think that taxes will be increased, but it is a long road to getting something permanently passed. And, one of the things that I've seen in the past, and I'm just not certain about this as an investor, but some investors try to play that and anxiously say, well, if taxes are going to be increased, what is the best way to position my portfolio or reposition my portfolio?
That's what we're getting, Pete.
Yeah. Yes, and they start getting a lot of questions about dividends, capital gains. Should I be, realizing them now because I might pay less taxes than in the future? And I'm not certain that is the best way to focus your energy on that, because that's uncertain. And the more important thing is to say, am I allocated correctly? What's my horizon? If I have college tuition on the horizon, then certainly I want to adjust my portfolio accordingly. But if I'm going to have a long runway before I need to realize this, I almost, and against a lot of other advisors' opinions, I almost say, look, don't let the taxable dividend liability wave your portfolio dog, so to speak, and just stay invested in the way that you think when you work with an advisor what your plan is. And it's very rare, minus what I just said about tuition plans or things like that, sudden need of capital. It's very rare for me to advise a client to make a cataclysmic shift based on, say, a tax policy that we have no idea, frankly, whether or not that's going to actually come as a modification or if it's just going to die on the vine.
Yeah, I mean, we've had this bull market for quite some time now, and I think that's where the issue is. You can probably can tell stories about that conversation, but people are they know a crash is going to happen. They just don't know how far deep it's going to go. So they're waiting, and I think there's still a lot of cash on the sidelines today.
Yes, and I sometimes think back to 2008. And when I had a conversation with somebody, it must have been at a cocktail party or something like that, and the person was saying, way back in 2008, okay, what are we going to do about inflation? This is going to be horrible. And what the Fed has been doing to get us out of this worldwide catastrophe. And look, we are over 10 years later. And I wonder what that person has done. I mean, if that person had made decisions based on an anticipated inflation, they would have really lost out of a lot of this huge market rally that's happened since then. And there's no timing of that. To me, it's kind of like, I tell them it's like jumping into a jump rope. You're watching this thing rotating. You're trying to time when you should get in or how you should modify for. Yeah, and it's impossible. And just get in the jump rope and start jumping, and have conversations, continuously checking to make sure you're still on course with what your best personal course is. But I remember back then thinking, boy, this is premature. It's 2008. We're in a catastrophic situation, and people are thinking about how should we position the portfolio for eventual inflation. And, I just bring that up because we're still having that conversation. And inflation, that's a whole other issue about how much is supply-demand masking what inflation really is going to be. And I mean supply-demand in the fact of coming back from a total shutdown of the economy. And I am in the school that thinks all of the inflation is going to be transient. And luckily, I have a little data now behind us where we looked at commodities, lumber prices. You remember recently as late winter, people were really shocked as to how much lumber prices had gone up. And now we see, it's like a perfect case where supply, demand, and the supply chain took care of things, and now we're coming back to earth. So I think as lumber and commodities, copper go, so will all the other inflationary asset classes out there, and we just have to sit this one through. But it's tempting not to, because we are in such a period of, I would almost call, unprecedented recovery.
Yeah, Peter, this is Michael. I'm really glad you brought up inflation, because that is one area that we've had a lot of conversations with our families on. So I'm really glad you touched on that. And as it relates to commodities, I mean, we're seeing a lot of families ask us more questions regarding, precious metals and that commodities allocation in their portfolio, as well as real estate. Do you have any thoughts on that side of the world in addition to what you just discussed?
Yes. In terms of, say, precious metals, I am not a big proponent of them, although I know many people have a cogent defense of that and advocate using, say, gold. But, when you use just the classic tests of an asset and valuing it by its cash flows, certainly something like gold or any of the other precious metals just don't throw off any cash. So it's hard for me to use like my standard training in terms of valuing things and applying that to metals. However, I know it is an emotional connection that a lot of clients have. I've learned over time, some clients are trainable in the sense that you can convince them of certain things, and then you can't go beyond a certain level. And I have found that clients that have an interest in commodities really are always going to stay in that interest. So I do try to work with some of them that have that interest, but I do fully disclose that, I don't necessarily believe in the asset class the way others do, but we do see that has been a tremendously popular alternative when people start really getting frightened about inflation.
Yeah, the other question that we get asked a lot of is the international scene. I know that might not necessarily be in your bailiwick, but I'd be interested in your thoughts. That you look at the international sector of this world economy, it's a lot of areas crashing and burning right now. Is that going to affect the United States over the short term, long term? How do you think that's?
So let me tell you, in a prior life, before I started Andersen Capital Management, I have been chief investment officer in large firms and really did have to advocate, full diversification of portfolios, meaning international asset classes. And I never was ever satisfied that it brought anything to the table for investors other than the optics of a nicer pie chart showing that you have this distribution among all these other asset classes. And the reason I never really felt comfortable, a number of reasons. I mean, early on in my career, I was high-yield bond analyst, and just a quick story about this, we invested in emerging market debt. And one of the days we were on a conference call with an analyst from a sell-side firm who was going to be reporting from ground zero about a certain company. And it turned out that while we were waiting for him to come on, the operator came on and said, "Oh, I'm sorry, we can't have the conference call because martial law has been declared in the country where the analyst was reporting from, and he couldn't leave his hotel." And so I think our job is hard enough in the United States to figure out what the heck is going on with stocks and analyst opinion. Throw in a lot of other geographic distance, the risk of martial law, and it's even harder for me to really have a confident opinion, I'll be totally honest with you, about making a recommendation in those countries. Now, that might be an extreme case because certainly, in Europe, there are not all countries are at that risk. But I do find it's extremely difficult to have an equal amount of confidence in countries like that compared with the confidence I have in U.S. equities and U.S. fixed income. Now, part of that is a diversification scheme. You can say, when something zigs, the other zags. But as we've seen, when the world gets really tough, everything moves in the same direction. It might be temporarily, but I do think that is what we've experienced in the past. But just coming back to your original question, I do always believe, frankly, and have witnessed that the U.S. is, in my opinion, the best place to invest under any circumstances. And I would never bet against the U.S., but I think that there are situations where I would bet against other countries outside of ours.
Now, that was great, Peter. One other question. You mentioned in a prior life you were more in the high-yield bond space. I'm interested to hear your take on sort of where we are interest rate-wise, your outlook on fixed income, and maybe some opportunities there.
Yes, yeah. So I always recommend that clients, no matter how uninteresting an asset class it might be or underperforming, that they do have investment-grade U.S. fixed income in the portfolio. And the main reason I advocate that is not because of the income. I mean, the income is paltry at this point, but it's always a good ballast against when we feel weakening in the U.S. markets, U.S. equity markets. U.S. fixed income is even treasuries, and I know the treasury rates are horrible, and most clients will say, why on earth would you ever recommend that? But you want to have that as an insurance policy. Well, I shouldn't really say insurance policy because it isn't, guaranteed by any means, but as a possible buffer when the equity markets start to sell off sharply. It's almost a physical law. And, we don't have many physical laws in investing. A lot of quantitative analysts try to convince you of that, okay? But there's no real set of physical laws, except maybe for risk and return, but also equity versus investment grade fixed income. It is a wonderfully predictable pattern that if we sell off in equities, you will look like a genius if you've had some boring fixed income. So I always recommend clients to have some amount in it, not for income, but for protection if things were to wane more sharply.
All right, so what would that allocation be, Pete? Would it be 10% of the portfolio?
Well, of course, it depends on... Well, it depends on everybody's demographic. Everybody is different. I've learned in this business that, you can have a formula for out of a textbook that a college professor would have taught you, and then you actually sit down with a real human being and it's more complicated, right? I mean, they have psychology involved. They might have come from, and I'm sure you've come across this. I mean, I've had clients whose grandparents were in the Holocaust or, through just great depressions.
Yep, I've worked with them. Yep.
Yeah, and so there's no convincing them, to get really rolled up, so to speak, in pure equities. So on a case-by-case basis, I will tell you this. It ranges from 10, 15, 20% all the way up to somebody that might be extremely conservative to 50%, because if you've got, as I said back earlier, if you have a liquidity event scheduled, or college tuition or a wedding or something like that, then you definitely don't want to put that money in a lot of risk. And so the range is that way. But I also always advocate that they do have some S&P 500 type exposure, because that's important too.
Sure. But let's go back to the international side for a second. China has become a major conversation for everybody. Two things. One, what do you think about China's ability to outpace the U.S. into the future? I know you don't have a crystal ball, but that seems to be a concern that some people have. And the other piece is, on a global standpoint, this 15% corporate tax that the G7's talking about. Like, you can't put your money in other countries for no tax. You're going to pay minimum 15. Where do you think that's going, along with are your thoughts about China?
Well, China is certainly in the headlines. It makes a very attractive story. Let's just, tie in the whole press situation that, plays on fear. And I think it is a justified fear. I will say this, that tying in with don't bet against America, the U.S., I still think that the U.S. is the best in terms of entrepreneurial thought and development, and, following through with incredibly creative solutions to things, and that other countries tend to follow our trending. And they may be very bright, and they may be hard workers, but I think they lack what I would call like a free market entrepreneurial stimulation and encouragement. So yes, I think China can perhaps catch up to us in terms of numbers of soldiers, or however you want to use, the common metrics. But my surveillance of physics, for instance, mathematics, the U.S. is the best. And I hate to sound nationalist, but I do totally believe that. I think that the best companies have come from the United States. You look at companies like NVIDIA, Amazon, all the other big companies, Facebook, they may be controversial in some areas, but I just don't think they could have been created anywhere else. So that's kind of the philosophical answer, right? I mean, that's kind of the 10,000 foot altitude answer. But in terms of like practicality, yes, I think that copyright issues of technology can be threatening to us. And I do think that what might hold that back is the fact that we seem to forget that it's a communistic country. I mean, a lot of these discussions we have, I don't know if people just suspend disbelief or something, but we always have to remember that we're talking about a country that is communistic and not at all a free economy, and really suppresses a lot of the, public opinion of that country compared to what we're going through now, which is, the total opposite. So when you look at those things, I think the technology over there is important. I think it's powerful, but I never worry that they will overtake us in the long run.
Okay. So how about this 15% corporate tax across the land? What
I've never been a proponent of, well, first off, philosophically, I don't support it. But in terms of the reality of that getting done, I think we've had enough. We can see in the human lab of Congress, right, in the House, that it takes a lot of negotiation and a lot of discussion to get even a U.S. tax passed through. So I don't put a lot of high probability that this will actually get passed, and I don't worry about it at this point. When would I worry about it? Well, when it actually was in, say, the 9th inning of getting this done, then I would say that it's important. But in terms of all the other things I worry about, it's very, very low in the priorities at this point.
Okay. All right, we'll come to an end of our time today, but give me your crystal ball, Pete. Where do you think we're going the next couple of years? Maybe the next 5 years, if you were to take a good guess. Where do you think we're going as a country? and as a financial...
Boy, it has been remarkable. I think you and I talked earlier this year. We turned the page to January, and I don't know what happened, but all of a sudden I'm reading about space travel, cryptocurrencies, all kinds of drones that are going to transport humans. And I think, well, that's nice science fiction, but I don't think it's in the next 5 years. I really don't. A lot of people disagree with me, and a lot of people think that space travel for, I guess, personal entertainment is going to be a highlight of a technology to invest in. But I don't follow that. So here's what I think. I think that we will look back a year from now and we will say this has been a tremendous recovery, one that rivals post-World War II. With the baby boom era. I think that there will be some new name for that. Maybe it's going to be the post-COVID period. But I do also think that inflation, we'll still be talking about inflation the way we are now. I think the Fed is smart to say, look, we are in a monsoon right now, so we're not going to pretend we know anything about how much integrity this data has, because we're in a turning point. So a year from now, I think we'll look back and we will say, thank goodness we've recovered. We are thrilled that rates are staying low. And now we're finally getting to a point where we can make comparables, say, well, this quarter's earnings, how does it compare to, say, the quarters pre-COVID? But to be honest with you, I don't do a lot of earnings comparisons right now because I just think it's nonsense. There's just no way to really know where we are. And then 2 years from now, I think we will start saying, okay, everything is back. And now we will start to see the Fed putting pressure on rates. And to be honest with you, when before COVID, I thought rates were too low anyway. I thought that the economy was running like a top and that it was artificially low. But I think it's a godsend coming into COVID, so the artificially low rates have helped us. But within 2 years, we're going to start to see the 10-year pickup, which we should. I mean, I think a 10-year normally, when I was, raised in this business, it wasn't unusual to talk about 10 years that were, 6 to 8%.
I remember that too. It was like normal. It was like,
Exactly. So we need to get back to that normalcy because there's a lot of people in our business that think this is normal. But, you talk to somebody that's been in a business 20 plus years and any of us will tell you that this is very, very not normal a period of time. And I am totally optimistic. I think that we have gone through this thing tremendously. We've gotten we will look back at the vaccines and say, I think we're so busy, we can't take a breath and, pat ourselves on the back and say what remarkable progress we've made in the past year. Because we are always thinking of the next problem, the Delta variant or the Epsilon variant, whatever will be after Delta. But, I remain optimistic. I've always been optimistic, and this is what I tell clients. I'm a mindless optimist. I just think that human nature, if you want to get really philosophical about this, we are wired to always improve our lives, period. And that will never stop. And I think we'll see that emerge in much stronger form and much more polarized form within the next couple of years.
That was a great conclusion there, Peter. Unfortunately, we're out of time for today, but I want to thank you for coming on because I really think you shared some great insight in where we are, where we might be going, and again, I particularly like that conclusion there. Stay optimistic. I think that's an important. Thank you. It's an important key component there. So thank you. Yes. Thank you so much for being a part of this today.
Yeah, I appreciate your time, Pete. I know how busy you are. I appreciate it.
You're very welcome.
Guys, this was a fantastic podcast. Thank you so much, Peter. Again, I love the optimism, so thank you so much for bringing that to the podcast. These guys have so much educational material, and I know that the audience is just floored by how much they bring to the table already, and to have somebody come on and kind of talk about the future a little bit and share that optimism is always a blessing. John and Michael, thank you for bringing them on the show. And of course, our last thank you goes to the listening audience. Thank you so much for tuning in and listening to the Truth About Wealth podcast with John and Michael Parise. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when John and Michael come out with a new podcast, it'll show up directly on your listening device. This makes it much easier to share these podcasts with your friends and family. Again, thank you so much for listening today. For everyone at Copper Beech Financial Group, this is Eric Johnson reminding you to live your best day every day. And we'll see you next time.
Thank you for listening to the Truth About Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Copper Beech Financial Group. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.
This material is for informational purposes only. Neither APFS nor its representatives provide tax, legal, or accounting advice. Please consult your own tax, legal, or accounting professional before making any decisions. Copper Beech is not affiliated with American Portfolios Financial Services, Inc. and American Portfolios Advisors, Inc. Securities offered through American Portfolio Financial Services, Inc., a member of FINRA SIPC, investment advisory and financial planning services offered through American Portfolio Advisors, Inc., an SCC registered investment advisor. These opinions are subject to change at any time without notice. Any comments or postings are provided for informational purposes only and do not constitute an offer or a recommendation to buy or sell securities or other financial instruments. Readers should conduct their own review and exercise judgment prior to investing. Investments are not guaranteed, involve risk, and may result in a loss of principal. Past performance does not guarantee future results. Investments are not suitable for all types of investors. Copper Beech is an unaffiliated entity of American Portfolios Financial Services, Inc. and American Portfolios Advisors, Inc. Any opinion expressed in this forum is not the opinions of American Portfolio Financial Services, Inc. and American Portfolio Advisors, Inc., and have not been reviewed by the firm for completeness or accuracy.